Morning everybody. So we're here this morning with Seamus and with Elliott from BVP. We've worked with BVP for the last number of years on EIIS. So we're just going to have a little bit of chat around what the guys do and maybe what we'll be doing this year and maybe why you might consider taking a look at EIIS for yourself. Morning guys, great to have you here.
Hey, how are you guys?
Okay, so I suppose maybe just by way of an introduction, do you want to just tell me a little bit about EIIS?
Sure, yeah. EIIS has been around for since the last 40 years. It's been in different guises. So it was originally the BES scheme, the Business Expansion Scheme. More recently now it's called the EIIS scheme. So it's the same scheme, more or less, with a different name. It's been broadened as well. It really does suit a lot of taxpayers. You don't have to be a high net worth or a person with a lot of resources. It really suits everybody from teachers to civil servants to professionals to business owners. Really everybody can avail of it. It's a very broad product for people. Typically, people with pension contributions can supplement it with an EIS contribution as well.
That's interesting, Elliott. Actually, what we find a lot of the time is we'll have guys who are contributing to a pension, but say, take for example a professional who has limited scope to contribute on an annual basis. They'll be looking for, okay, what's next? What can I build on top of that, and where can I find more tax relief? We'll find people like that. We'll also maybe find a cohort of people who have income such as from rental property that they can't shelter through pension investments.
Yes.
So is that typical of what you see in your clients?
It absolutely is. I mean, like what we find is that people like yourself will advise our investors to put not a significant portion of their annual income or their net resources into an EIS scheme, but to have a certain percentage of their annual income into something like this, and do it every year as well. So it's a very nice exposure. Quite often it appeals to investors as well because we're investing in Irish companies. These companies tend to have products and services that resonate with ordinary folk, small businesses which are in the community or in further afield. We invest in companies from Donegal to Kerry. Our investors are from Donegal to Kerry and right across the country. So really there's a very nice resonance there in terms of what people actually get involved in. Yeah. They can see that themselves, and they can see the companies and even research them themselves and see their websites. And
I think we might go on and get into the meat of some of those companies and what they are and what they do in a little while. But I suppose the primary motivation then for people to get involved is tax. Seamus, I don't know if you want to touch on that, maybe on how the profile of the relief works.
Sure.
Maybe the sequencing of relief.
Yeah, probably the first thing to clarify just is in terms of the tax relief. Firstly, it's 40%. It historically had been done on a say 30-10 basis. Now, a couple of key things is we commit in terms of an indicative date to have it the certs back for our clients, typically 14 odd months post the year they have invested, and then they can actually claim the relief.
So that's quite compelling for investors, right? Because you're de-risking yourself from the tax basis before you know what the business has done.
Correct, and probably a bit to Elliott's point too, it's why we also sort of talk to advisors about when they're engaging with their investors that this is something, as long as their circumstances don't change, that they're doing year on year. Again, there's added diversification within each year's fund. We're typically allocated to say 6-8 portfolio companies, so there's further diversification if you're doing that year on year with ourselves.
Excellent. I suppose the format that takes is that the person making their tax return can then claim relief at that stage. So it's
correct. Yeah.
Off the top. Okay, so I suppose then maybe to look a little bit under the skin of the type of businesses you invest in. Do you want to give us maybe a little bit of flavour around that?
Yeah, absolutely. So they would tend to be but they're small, medium-sized companies. They're usually in existence for 3 to 4 years. Occasionally might be a little bit younger, but typically they will be generating revenue. Again, one or two exceptions to that, but generally would be generating revenue. They would have a management team. They would have the founders. We would be impressed by them. That they maybe have been involved in previous businesses, so they'd have a track record before the companies they set up, the 3 to 4 years.
This is important, I think, in a way, in that from our experience with you guys, actually some of the founders of these businesses would be well known. The public in general might know who some of these people are.
They could be. They could be. So, or not. But typically we'd be able to trace back their credentials before the company that was set up. So they'd have expertise, and something we've learned is that their expertise in previous businesses is critical to what they bring to the current company. Their connections, their pipeline of customers, their general expertise in the industry. That is very important. That's what we're actually backing. Typically, companies that need investment, they need the extra capital to grow their teams. So they're employing more people. They're plugging gaps within their management teams as such. So that's a really important part of it. It gives them the leverage to export as well. So they're not just based. Quite often they're not depending on the Irish domestic market and the vagaries of the economy. They're diversifying beyond these.
So I suppose in a way it's like people saying business, you back people. But you also need to have the right product at the right market at the right opportunity. I suppose if you go back to where you started on this, this is an evolution of what was called the business expansion scheme. So this is growth phase businesses.
Absolutely.
And the other important point I'd make too, just in terms of the discipline for us on the investment side, and we'll obviously touch on it again in a few moments too, but the screening process we have to make sure that they are eligible for the EIIS scheme. Secondly, that we can evaluate them from a commercial and operational point of view, but not just in the pre-investment process, but also post. And so that means we're either taking a board directorship as part of the investment, or secondly, the right to have an observer role there too. So there's the diligence throughout, not just sort of
So you guys are active investors.
Absolutely.
Yeah,
100%.
It's so important. I mean, business is successful because if people persist and they continue to work the business essentially. So we're not just making a single day investment decision. We're working with the company for the period of our investment. So actually 4 to 5 years.
So the life cycle of it. Yeah. That's nice, but that conveniently leads us on to the life cycle of this investment.
Yes.
You're starting out on day one with placing the money with yourselves. There's a process then whereby you must place that money in the business, who must meet certain criteria to qualify for the tax relief. That's, like you described, maybe 12 to 15 months. Thereafter, then you're looking at possibly the exit part of that cycle is probably year 4 to 7, if I'm correct.
Yeah, it is, and it's a good point. I mean, I suppose we obviously, when we get into the investment in the first place, we have to feel that there's a good potential to get out of it as well. So and we explain that to the business owners too, that this is not we're not in here forever. They would be typically, but we need to know that there is a potential exit route. So they're either going to build up cash in their business to buy us out, they're going to have their own resources to buy us out alternatively, or they find another investor or another company to buy out our shares or buy out the entire company. So that's typically there's 3 or 4 different mechanisms for us to sell our shares.
At this stage, you guys have been at this a long time. I think you're onto your 15th fund at this stage.
That's right.
So you've seen this journey in reality. Do you want to maybe touch on a few exits that you've seen? Maybe not going into specific companies, because I know we're going to go into that later, but typically, what does it look like? What's the experience?
Yeah, the experience in our scheme is that probably the first route to exit is the company themselves buying us out. So that could either be the company themselves with the resources, or the actual founders themselves buying us out, and that's probably the most common route. We also have had exits from the business being sold as well, like a trade sale, they call that. So really, they're kind of the three main ways our experience has been, that way.
Yeah, and I suppose the other sort of key thing to get across here in terms of our proposition, it's an impact fund. So I'm sure it's a conversation a lot of you're having with your own sort of clients, and they're considering it more too. And so when you look at, and for obviously institute investors and things too, we have the collateral, but just where we look at it from a sustainability point of view in terms of impact on society, etc. too, and you'll see that in terms of some of the
that's interesting.
companies
That's actually a theme that we've seen with our clients over the last while, is that this kind of thing is becoming more and more important. I suppose there are regulatory drivers and such like, which eventually are going to point us all in this direction, but you want to be in front of the ball on this.
Yeah, I mean, we think it's a very positive theme. We don't lose sight of the fact that the investment has to make money for our investors. It has to be redeemable at the end of the 4 to 7 year period. But there is this renewed interest from investors, and we think it's certainly a lot of the regulatory drivers and policy drivers are in favour of this. So it's just we're addressing this issue, and clearly climate change it's a fact. It's a scientifically proven fact. So we're investing in things that are actually addressing these issues, and there's other social and diversity issues as well.
I think
that we're addressing.
See that in some of your investments. Some of them would be quite obvious, and use some project type stuff like wind farms.
Yes, yeah.
But looking more broadly across your portfolio of companies, there's quite a range of stuff, from technology businesses to med tech, to, again, touching on a lot of the green type stuff there. Do you want to maybe give a little bit of flavour around the type of business that you look at?
Yeah, so it's very, as you say, it's very broad. So we've invested in a company a couple of companies in the medical area that would be using technology to bring medical therapies into the home, to help people. So we've two examples that are public information. So a company called Health Beacon and a company called Food Marvel. Both of them are enabling people to have a little gadget to help them to keep their medication, or help them to analyse how their digestive system is working. That's both of those products. So this is a very much common trend where your doctor is encouraging you to monitor your own health and wellness. So technology is enabling this to happen in a much faster pace.
You're dealing with companies that are selling into a market that really meets modernity, right?
Yes, it is. Yeah. So this is possible. Obviously, the cost of care, in hospitals is only going one way, whereas there's obviously public trend and technology enabling this to happen is that people can be looked after in the home, and they can have ways to do that. So the technologies. So we're investing in companies that are enabling this to happen.
That's great. I suppose, guys, if I can loop back and maybe more from the perspective of our clients, one of the reasons why we've worked with you guys over the last number of years is that rather than dealing with a monoline investment or a single good idea, you guys each year will typically invest in 7-8 companies. So there's a diversification benefit. We talk to our clients about the benefit of it's having not all your eggs in the one basket, but many different parts to that. So by using a fund structure, you gain that diversification benefit. But I think to go beyond that, what the conversation we'd have with a lot of our clients is that if they're investing small part by small part, year after year after year, going to end up with a broad portfolio. So that narrows the risk profile of their investment. Is that typical of what you see amongst your broader investor base?
It absolutely is, and we've seen investors that have invested with us now 7-8 years, and the money is now coming back to them. We're making distributions to them, and they're actually starting to be able to part fund and in some cases fully fund their next investment in our fund. So as the money comes back, they're able to part fund their new investment.
So it's that ongoing journey.
It's an ongoing journey, and obviously some funds, as with all investment portfolios, some portfolios do better than others. So then they're able to get the pluses and the minuses with that, and it creates a nice cycle of cash flow.
Yeah, I suppose again, there's two ways to look at this. One is, as Elliott touched on, the diversification at two levels. One, within each fund, the number we allocate to each year, and then doing it every year. But then what we discussed previously in terms of the receipt or process of payment back. So essentially, client invests end of, say, this year, because we raise in calendar year, 14, 15 months later, they have the relevant paperwork to put in their tax relief claim, and then if they're doing that every year, every 14 months plus, they're able to put in the claim for the relief, and then once the first fund hits the 4-year anniversary, you're starting to see proceeds paying back.
Which is fantastic, right? That feeds back into what we do for a lot of clients in basically looking at a life cycle of financial planning.
Yeah.
So you're looking at a series of cash flows. Day one going with you guys, money going in, that's probably a 7-year cycle, but if you're doing it year on year on year, well then that can build into a life cycle of cash flows. Guys, look, thank you very much for coming along to talk with us this morning. I think we're heading towards if I'm correct in this, your fund will close out at year end this year.
Absolutely.
So I suppose we're starting into this season at the moment. You're here to talk to anyone. Definitely anyone out there who would like to have a conversation with us, or indeed with the guys, please feel free to get in touch.